Hey everyone, welcome to the Leading Indicator Podcast. I'm your host today, JD Durkin. Today's show is brought to you, of course, by iShares. Today we're going to talk about two of the largest thematic trends to watch in the back half of 2024. Those things, of course, being artificial intelligence and in this very important election year, the issue of geopolitics as well. Today's guest, I'm excited to say, is Jay Jacobs, the U.S. head of Thematic and Active ETFs over at BlackRock. Jay, I appreciate you being here on Leading Indicator.
Yeah, happy to join, JD. Thanks for having me.
So, of course, a major conversation point has been consolidation, this concentration in the S&P 500. We've been talking so long about these so-called Magnificent Seven stocks, these key consolidated names, and how much of the overall S&P they account for. Let's start there, Jay. Do you see these Magnificent Seven or so names continue to outpace the rest of the market, or do you see some more rotation and therefore less concentration?
Yeah, I think the market's going to start looking beyond the Mag 7. They've had a terrific run. They're tremendous companies with tremendous moats around them. So there's nothing wrong with why these companies have done so well. But the tailwinds, the structural tailwinds behind them are not just limited to the Mag 7. If we look at artificial intelligence being such a driver of market returns this year, there's really a value chain of companies across many different sectors that stand to benefit from the rise of AI. And yet, thus far, the markets have just been really focused on some top-heavy names. So what we expect is, as this theme grows and as people gain a better understanding of the winners and losers in this technological revolution that is artificial intelligence, that's going to really start to expand the pool of companies that benefit from this theme.
Are there other companies that you like as well? I mean, one of my questions I like to ask analysts is if there were a company to add to the Magnificent Seven to make it the Elite Eight, are there other names in this space? Like an AMD is a popular answer. I wonder if there's others you've looked at or have been following from the sidelines.
Well, we look at it more categorically, which is which parts of, we talk about the AI tech stack, which parts of the AI tech stack are poised to benefit from the rise of artificial intelligence. And so, one area is, yes, semiconductor companies have done very well thus far, but there's an entire ecosystem of semiconductors that are going to benefit from the rise of AI. First and foremost, GPUs, graphics processing units, have been kind of like the main semiconductor that the market is focused on. The best producers of GPUs have been the most rewarded over the last year or so. But GPUs don't work unless you have high bandwidth memory chips, HBMs. That's kind of like if you have a really powerful engine, you need a really wide hose to get gasoline to it. So who's making those wide hoses? There's application-specific integrated circuits, or ASICs, which are really designed to do processing for artificial intelligence.
You have a broader semiconductor space that should be benefiting from AI's rise.
Talk to me about any concern that market consolidation has. I think for a lot of investors and maybe a lot of people we have here at Public, maybe they haven't been investors for all that long. So all they kind of know is this hyper concentrated market. Are there historical warnings against having such a consolidated S&P 500 where you kind of have this at times divergence between how well those few concentrated names do relative to most of the other companies in the index?
Yeah. Sorry, I think I got my voice back here. I just get all choked up when I talk about semiconductors.
It's an emotional issue. I get it. Yeah.
What you would expect to see is if the macro environment strengthens, that there'd be a broadening of the opportunity within equities. If interest rates start to be cut by the end of the year, that generally makes equity valuations more attractive, and you start to see, an expansion across all stocks. But also when you see these really big growthy tailwinds in the market, it really should impact many different sectors. To take it a step further, and now that I actually have my voice, I can talk a little bit more. Semiconductors are just one way to think about AI. Another way to think about AI is from the real estate perspective, which is that these semiconductors have to be hosted in very specific locations that have cooling, that have access to cheap energy, that are close to city centers. And so the data centers that host these semiconductors suddenly become very valuable and very important to that value chain. Now, taking it a step further, semiconductors don't just need real estate. They also need abundant amounts of cheap energy. And so what we are projecting going forward is really a landscape shift in the amount of energy demand in the United States from the growth of AI, from a resurgence in U.S. manufacturing, which is a huge energy source of energy demand, as well as the growth of electric vehicles, which is also going to require a lot of electricity. So you add that all together, And really, there's a pretty significant opportunity in just looking at things like utilities and the electric grid and electric storage and just general energy production in the United States. So, again, as you look further out to artificial intelligence, it just paints such a clear picture that this is not about 7 companies. There's entire sectors that are going to benefit from artificial intelligence. You just have to be thoughtful about kind of what those sectors are, from energy to materials to real estate, and getting a little more granular within those sectors to find the winners.
So since you mentioned AI, let's get right into the report, because that's one of the 2 mega trends that you highlighted. And of course, we're referencing BlackRock's new mid-year thematic update. Those 2 issues being AI and geopolitics. We'll start with the former. To your last point, Jay, where can investors look to find some of those more underappreciated assets? I mean, the global semiconductor industry is projected, as you know, to reach $1 trillion in revenue by the end of the decade alone. So where else are you seeing those opportunities outside of those few key names that we seem to talk about all the time?
Yeah, so it's really across the semiconductor space, right? So it's not just that GPU story. In fact, the reason why GPUs are so valuable today is because we're training a lot of AI systems. It's like if you're learning how to do algebra for the first time, it takes more brain power than if you've been doing it for years and you can just crank out, worksheets in a textbook. So right now we're learning algebra for the first time with AI, but going forward, we're going to start doing more inference, basically just the same AI models answering questions over and over and over again from people who are interacting with something like a ChatGPT or a Claude or whichever platform of choice you're using. That requires a different kind of semiconductor. That's more CPUs or central processing units. So there's really opportunity across the semiconductor landscape. That's why we're pretty excited by just investing in a semiconductor subsector ETF like SOXX from iShares, because you're really going to get exposure not to just one semiconductor company. It's really about looking at 30 of the leading semis across the world.
Yeah, maybe it gives investors the opportunity to ride the wave overall, as opposed to just sort of being pinned to one key name. Expectations, obviously, for this space, Jay, they have been very high. They remain very high, especially as we look at things like forward PEs and future earnings potentials for a lot of these names. But you actually think the market is underestimating how much money will be spent. How historic do you think this CapEx spending cycle really can prove to be?
Yeah, this could be as high as $1 trillion by the end of the decade. This is just a tremendous build out to support all of this AI demand. What I think is so interesting about it, though, is, on one hand, you have Silicon Valley moving at the speed of all things digital, which is very quick. You can rapidly innovate in the digital space. You can train up new models. You can go from ChatGPT 3 to GPT-4 to GPT-5 relatively quickly in digital land. The problem is that only works when you have real physical AI infrastructure behind it that enables digital to move that quickly. So, it might sound like I'm a broken record on semiconductors, but if you think about how much demand that is for semiconductors, how much demand that is for digital infrastructure with data centers, how much demand that is for electricity, it's tremendous. And the problem with all of that is the physical world tends to move more slowly. If you want to build a new data center, you got to go get a permit. You got to go find a contractor. You got to pour concrete. You got to build this thing. And it takes, in some cases, can take a few years. If you're really trying to rebuild the electric grid to handle all of this new electric demand, what you need is a lot of copper and a lot of different raw materials. Unfortunately, the world is actually undersupplied in copper. We have a copper deficit this year and projected for the next few years out. So, okay, let's go dig up more copper. Well, copper takes about 10 years to set up a new copper mine and have it start producing usable copper. So AI can and will grow very quickly, but I think investors would be wise to think about what are some of the physical constraints to artificial intelligence, because that's where a lot of pricing power is going to be. If you own and operate a data center, you have a very valuable piece of property. If you own a copper mine, you have a pretty valuable piece of property these days. And if you own a semiconductor fab, that's a pretty valuable thing as well, because some of these semiconductors being used in artificial intelligence are really undersupplied, or there's 6 to 12 month backlogs in trying to get your hands on these semis. So again, the digital world's moving very quickly. The physical world is actually where we see some of the most investment opportunity, because these existing assets are hard to come by.
How might how big of a risk might that copper situation end up being in terms of an overall threat to the supply chain? And are there sort of potential solutions or opportunities there as opposed to threats that you see that could emerge?
The switching costs are high. I mean, copper is a great, generally low cost conductor of electricity. So, you could use silver or gold too. That's obviously a lot more expensive. So people do not want to do that. But it's kind of the metal of choice when it comes to electric transmission. And, if you're going to be building more batteries, you're going to be building smarter grids, you're going to be building more electric generation, whether that's fossil fuels or renewables, kind of all roads lead through copper. So there are other ways, you can recycle copper. You could be switching the use case of copper. So some copper that might be used in things like physical infrastructure or building materials, maybe go to another metal. But in a lot of ways, it is the main metal that's going to be required for all this electrification. So there is some risk there. And I think that's going to lead to higher copper prices over time.
Were there any surprises in your report on the AI side that you learned?
Yeah, I think the biggest surprise is really this electricity story. And if you take a step back, the U.S. has had basically zero electricity demand growth over the last 10 years. There's been some population growth, there's been some economic growth, but electricity demand has been flat because there's been some gains in electric efficiency, switching to LED light bulbs, more efficient processors and computers. And so it's been flat. And, the way that a lot of utilities operate in the United States is really trying to anticipate very low demand growth. Now, with AI, with electric vehicles, with manufacturing, electric demand could be growing 2 to as much as 3% a year for the next decade. And in utility terms, that's a gold rush. I mean, that is a phenomenal change in demand growth. And, I think it's going to take a few years for just kind of the entire energy infrastructure space to realize and adapt to this new reality of growing electric demand in the U.S.
All right, we got to talk about the other half of the report. That's the impact of geopolitics. A huge year for elections. You may have heard there's a big election here in the United States. We all get a bit of a preview for the presidential debate this week. Well, let's talk the foreign policy angle. Why does foreign policy matter for domestic companies here in the U.S.?
Well, I would caveat the geopolitics point, which is, we have a big election in the U.S., but over half the world's population is voting for new leadership this year. So it's not just a U.S. story. You've had a big election in India recently, in Mexico. There'll be elections in the European Union, in Brazil. So really major, large populous countries are going through their own elections. And I think, in a lot of ways, elections kind of bring politics into the forefront and maybe exacerbate some political issues that have already been in place for a few years, but now are front and center and on the front page of the New York Times. So that's bringing geopolitics into the fold is one of our major themes through the end of the year. What are we seeing? A lot of what we're seeing in the United States is whether you're on either side of the aisle, a lot of positioning around U.S. production. If we go back to the COVID-19 crisis, we learned very quickly the risks of having a globally integrated supply chain. And in a lot of ways, companies and governments don't want to repeat that. They don't want to have supply chain shut down, especially in critical inputs into the supply chain, like semiconductors, like energy, like automobiles. And so you've seen from both sides of the aisle support for spending in the United States on infrastructure, on accelerating manufacturing, on tariffs with other countries, on changing trade policies and who our trade partners are. And this is really having a pretty big impact on manufacturing, both in the US and around the world. Where we're seeing that today is a huge increase in manufacturing construction spending in the US. So that's grown by about 50% over the last 5 years, meaning we're spending a lot more money to build manufacturing facilities. That doesn't mean those facilities are live yet. This takes time, but we've been putting shovels in the ground to build things like factories that build semiconductors. So that's a very good sign that manufacturing is starting to pick up in the United States. But what we're also seeing is major investments in infrastructure to rebuild roads and highways. And what we've also seen is a shift in our major trade partners. So towards the beginning of last year, Mexico became the biggest trade partner of the United States. Makes sense. Mexico's close. Mexico has much lower costs of labor than the United States. There's free trade agreements with USMCA. So it's kind of a natural choice for the U.S. to build deeper relationships with Mexico. But a lot of this was because we saw how, disrupted global supply chains were during the pandemic. We had issues at our ports. We couldn't ship things over from east to west very easily. So if you can move your supply chain to the south where, you can drive it across the border, that can really smooth out supply chains. So there's just a lot of focus on where are we getting goods from going forward. Do we build it in the United States? We will if it's an important segment of the economy. And we will build it next to the United States if it's something that we can outsource and do cheaper somewhere else.
Some of the bills that you mentioned, and you're not alone. I mean, we've heard them from the top analysts on Wall Street who say, hey, look at the manufacturing spend, right? Look at the infrastructure spending that we've done. Some of these bills have been led only by Democrats in the form of the Clean Energy Bill, what Democrats called the Inflation Reduction Act. Some of them were bipartisan in nature. I wonder to what degree you're concerned that spending like that, although there is and objectively there is a huge benefit, they also contribute to government spending, which puts upward pressure on the overall inflationary environment. How much are you approaching this election knowing that realistically, no matter who wins, which party's in power, those annual deficits will likely continue, as we've seen with president after president contributing therefore to the national debt, and a fair chorus of critics, as you know, Jay, who say, these are all forces. They're all well and good in the spirit of spending for manufacturing, but these are upward pressures on inflation, regardless of who's president.
I think that's right. I mean, whether you're doing tax cuts, whether you're doing fiscal spending with these big bills, they add to the deficit. So I think one thing is you want to make sure that money's being spent well. One of the great things about manufacturing is it has a huge multiplier effect on the economy. That one manufacturing job, by some estimates, can create 7 jobs total around the country. Now, if you're building a semiconductor in Arizona, now you need a truck to get it to a finishing plant. Now, it creates an economy around it. So it could be money very well spent. I think that's the first part. And if that multiplier effect is strong enough, then it will outweigh the additional, addition to the deficit. The second thing, though, is this is inflationary. If previously supply chains were going to go to the cheapest countries around the world to build things, and now we are prioritizing building things in the United States or near the United States for economic security or for supply chain security, that's a decision to spend more money. It just is. And maybe that's a better choice in the long run. You could argue that we'd rather have more expensive semiconductors than no semiconductors at all, if that's the trade-off in something like a pandemic in the future. But it is an inflationary force. And in fact, we have another major inflationary force that's happening beyond just, kind of changing supply chains. You have the growing deficits and you have aging populations where in the United States, in Europe, you have populations that are getting older and older. And it means workforces are kind of tapering in their growth or even starting to reverse in size. That's an inflationary force as well, because you have fewer workers to do the amount of work that we want them to do. So generally our view, across the firm within BlackRock is that inflation numbers might come down from here, but we're probably not going to return to where we were prior to the pandemic at that 2% level. There's some real structural forces that are likely to keep inflation here for a while.
That's great perspective, and I'm grateful for that response. Here in the U.S., talk to me about the things, Jay, that you see being most at stake for investors. A big conversation between the two candidates about the extension of the 2017 Tax Cuts and Jobs Act, also known as the Trump-era tax cuts. Give me your sense between that, inflationary pressures, overall view and perception of the economy. What's really at stake for people here at home as we inch closer to November?
Well, I think what should be on top of people's minds is a continued focus on inflation. I mean, that impacts all of us. Like I said, this might not even be a political issue. This is a structural issue across the economy that inflation is likely here to stay. No president can decide how fast we're going to age as a population, unfortunately. But the other thing that I think investors should keep an eye on is overall the economy is doing pretty well. If we go back 2 years ago, there was a lot of concern about a hard landing, about going into a recession, that we were, exiting the pandemic, too hot and things were going to cool off very quickly because of inflation and high interest rates. So far, that's not the case. So that should give people some confidence that the stock market and the economy should be in good shape. What's interesting, though, is that you still see a tremendous amount of cash being held on the sidelines by investors. There's still about $6 trillion that people are holding in money market funds or in cash because of inflation, because of high interest rates. Maybe people are happy to get 5% on U.S. Treasuries. But what that shows us is if the economy turns upwards, if we see an acceleration in the economy, if we see continued growth of the stock market, there's a lot more money that could come in and provide even more tailwinds to that trend. So, I think we're on decent footing.
I'm about out of time. If I can sneak in this last one, and we'll try and make it quick. Any emerging markets where you see opportunities?
Yeah, so if we look beyond the United States, we've talked a bit about Mexico, but India is another one where you have kind of warming trade tensions between the U.S. and India. You have a very large youthful population, a growing middle class, growing amount of consumption in India. They are very well positioned to be kind of a major trade partner of the United States and other countries around the world going forward. So this is one country where, if you're thinking 10, 20 years out, what's going to be kind of a major economic force to be reckoned with, India is going to be climbing the charts pretty quickly, probably the third largest economy in the world in the next few years. So that's one to keep an eye on as well.
Yeah, India is probably the most popular answer that I've heard to that question in the last few years. It's an outstanding report. I encourage all of our investors and our readers or viewers here at Public to go check it out. And I would like to personally thank our special guest today, Jay Jacobs from BlackRock, for taking the time. Jay, thanks a lot for being here.
Thanks for having me. Appreciate it.